The two most popular crypto investment strategies for maximizing returns from owned assets are day trading and hodling. In order to capitalize on sharp price fluctuations, day traders buy and sell cryptocurrencies on the same day. This is a short-term, high-risk strategy. Hodling is the phrase for buying and keeping cryptocurrencies in order to benefit from their long-term value growth. A proponent of Bitcoin first used the term HODL in a post on the Bitcointalk forum in 2013, and cryptocurrency aficionados have since embraced it worldwide. It can also indicate to cling on indefinitely. Day trading requires more skill, self-control, and logical thought processes. When hodling, cryptocurrency investors frequently place their money on long-term investments they believe will have a promising future. The more conventional stock and other asset trading techniques, including technical and fundamental analysis, are frequently imitated in cryptocurrency trading tactics. The primary distinction is that due to the aforementioned market volatility, profits in cryptocurrencies may be bigger and more rapid. Online trading has made it possible for investors to trade independently of brokers or financial institutions, making it easier for everyone to access trades than on the stock market. Additionally, the cryptocurrency market is open around the clock, every day of the year, giving profitable traders more volatility across shorter time frames for greater gains. While preserving and developing all of the conventional trading tools, cryptocurrency has given institutional and ordinary investors a new trading strategy. The real query is, should people hold crypto or purchase and trade it? Today's video is about what are day trading and hodling strategy. At Finance Doc, we will be sharing more explanation videos related to cryptocurrencies, trading, forex, and many more. So watch this video till the end and hit the subscribe button and click on the bell icon to get notifications for our future videos. So let's begin the video. What is cryptocurrency day trading? One of the many trading methods, day trading involves entering and quitting opportunities on the same day and necessitates extensive knowledge of the market. Technical analysis, TA, will be heavily used by day traders to determine trade entry and exit positions. TA will use popular indicators such as volume, price activity, and chart patterns. So, is cryptocurrency day trading profitable? If a few elements are taken into account, such as the kind of personal investing goals and a trading approach that matches the investor's personality, day trading can be highly advantageous. Day trading may be tough and extremely stressful because it is dangerous and demands quick decision-making and execution. Day trading cryptocurrency is a demanding activity with more frequent trades than other trading techniques, since it tries to profit from minute changes in market volatility. More so than day trading stocks or commodities, the return in the cryptocurrency market can be quite alluring because it's not unusual to see a crypto asset rising sharply in value the same day. However, effective risk management and the right application of technical indicators are also necessary for day trading success. Another important component of effective day trades is liquidity, which is essential for speedy trade execution, particularly when leaving a position in the volatile cryptocurrency market. A higher possibility of execution is ensured by a trading pair that is more liquid. In day trading cryptocurrency, fundamental analysis is not as important as technical analysis. However, keeping up with news and other updates might be useful for determining any short-term effects on asset values. Investors might employ a few day trading tactics. Scalping is a strategy that takes advantage of increasing trading volume to earn modest gains from small swings in the quickest amount of time, frequently within minutes from an entering position. To increase their gains, scalpers frequently employ leverage while trading on margin or futures contracts. Another well-liked tactic in the cryptocurrency industry is arbitrage. It entails purchasing a digital asset on one cryptocurrency exchange platform, then selling it for more money on another platform where the value is higher. For instance, a $500 price difference might not seem like much, but if a trader purchases a large quantity of an asset on one exchange and then quickly sells it on another platform, the profits could be sizable. What is a cryptocurrency hodling strategy? A reasonably simple long-term cryptocurrency investment method is hodling. Investors must purchase a coin or a token and store it safely for a long period of time, often years, until they can sell it for a profit. Typically, the hodler won't sell and is unaffected by price changes. Hodling can be a safer alternative for investors since it reduces their exposure to short-term volatility and eliminates the risk of buying high and selling low, which is a common occurrence in the cryptocurrency market. Even when the market declines or becomes extremely volatile, true hodlers are likely to keep holding onto their coin or token. How long should cryptocurrency be held? Your strategic approach and ultimately your beliefs will determine this. For instance, many hodlers of Bitcoin swear to hold the cryptocurrency forever because they think it will evolve into a brand new monetary system. The exchange rates between cryptocurrencies and fiat money won't matter to cryptocurrency owners any longer should Bitcoin or any other cryptocurrency achieve widespread adoption and displace government-issued fiat currencies as the foundation of economies. One of the most popular tactics for hodlers is to dollar-cost average (DCA) cryptocurrencies, which is taking numerous tiny holdings over a long period of time, independent of the asset's price, as opposed to a single huge position. DCA is not greatly impacted by volatility, and when used methodically, it may virtually eliminate any emotions from investment. Avoiding emotions like fear of missing out, FOMO, or fear, uncertainty, and doubt, FUD, which can imperil the entire strategy and facilitate losses, should be the sole statistic that matters when deciding how much of the preferred cryptocurrency to accumulate. Another crucial step is picking the ideal coin or token to hodl. Because they offer more security and are more trustworthy projects than smaller cap currencies, cryptocurrency investors frequently amass coins in the top 10 by market capitalization. Many of the thousands of coins and tokens that now exist in the cryptocurrency world will probably vanish in the future. Therefore, the most crucial judgment a hodler should make is whether cryptocurrency is worth their money, along with selecting the best tool to secure their digital assets. Focusing on the hodling approach and observing long-term chart trends can help you stay on track and prevent unfortunate errors like selling too soon. Thank you for watching this video. If you like this video, don't forget to hit the like button and subscribe to the channel so that you don't miss out on our upcoming videos.